What we're going to be going over here is direct materials price, usage, and quantity variances here. And it's going to be based on a standard costing system here using a flexible budget. Okay, so what I've done here, I've got it laid out in table form here. So when you're dealing with these variances, you have to look at really three different budgets that you're using here, or three different amounts. And you would start with your static amount here. That's really the budgeted quantity allowed for your product here times the budgeted cost or price that you're allowing here for those direct materials that are being purchased in this case. And really, that's a standard amount that's allowed here. So what you really do, these budgeted inputs, they're based on some standard that the company establishes for the product, or in this case, the material that's going to be used in the product, both for the price and the quantity that can be used. Okay, so you've established some static amount here at the beginning of the period here. So at the end of the period, or at the end of the period here, now you can determine your actual cost that you incurred here for this direct material that we purchased. So that's really taking your actual input quantity times the actual cost or price here. Okay, so those are the actual amounts. Now, what we have here for this flexible budget, or what we do here for our variance analysis, we have to take and determine our flexible amount here. That's actually taking the actual quantity that was, in this case, purchased here, taking that actual amount times the budgeted cost or price. So we're taking our budgeted prices from our static budget here that we develop at the beginning of the period here, and then we're taking the actual quantity or input here that we've used during the period. So that sets up our flexible budget. So now we can determine our variances between these three different budgets here. And the static amount here is really your standard amount that's allowed here. Okay, so for our direct materials, really we're dealing with price, usage, and quantity variances here. So let's look at what we're talking about here. For our price variance, that's taking our, in this case for our direct materials, our actual cost would be actual quantity that we purchased times our actual price. And then for the flexible budget here would be, again, the actual quantity we purchased times the standard price here per unit. So our price variance is really taking the difference between our actual price and our standard price, the difference there, times the actual quantity that we purchased. Okay, and for our usage variance, we can look at it in these terms here. This is the case where for your flexible amount or your budgeted amount here, that's the actual quantity that you used times the standard price. So for our usage variance, we're going, again, looking at it in these terms here, that the difference between our actual price here, and our difference between our actual price and our standard price, and that difference times the actual quantity that we've used. Okay, so for our quantity variance, that's where we're dealing with our flexible and static amount here. So this is the case here where we take the actual quantity, the difference between the actual quantity that we've used here and the standard quantity that's allowed for the product here. So that difference times the standard price, because both the flexible and static budgets use the standard price. Okay, so those are our three variances that we're going to go over and try to understand through some T accounts that we're going to be looking at here. And before we do that, let's just move over here and understand our hierarchy here for these variances here. So we got this total profit variance that would be under our operating income. And then what we have under that here is our price, cost, or flexible budget variances here. And then we're going to have this unit cost variance and a sales price variance. Well, our direct materials here ends up really under the unit cost variance here. We're going to have our direct materials, our direct labor, and our overhead variances. So that's where we're sitting here. So we're going to have for our direct materials, we're going to have some direct material price variances and direct material quantity variances. Okay, so we'll go on from here. What we're going to be going over here is direct materials price and quantity variances, and we're going to be calculating those, and it's going to be based on the standard costing system. So what I've done here, I've got it laid out in T account form here. So to understand what's going on with these variances, let's just begin to trace through these T accounts here, get just an overview of what's going on, and then we'll get into the details. So what you're going to do here is you're going to start out with some accounts payable. You're going to buy some of these direct materials that are going to be used in a specific project. And in your accounts payable, again, it's going to be a control account here, and it's going to be recorded at the actual cost we have for this material here. So we're going to have our actual costing recorded right in our accounts payable for the actual quantity that we purchased. And then we're going to inventory it in a materials purchase control account, but it's going to be inventoried at a budgeted standard cost here. So this is the case here. We're going to be taking we're going to have to determine our standard price here per unit that we purchased here, compare it to the actual price here that we paid for each of these units here. And the difference times the actual quantity that we purchased here is going to go into the direct materials pricing variance account here, because you're going to be comparing your actual price with your standard price. So that's going to be your price variance account. And then when we actually use those materials, we take them out of our materials purchase control account. We're going to move them into the work in process control, and they're going to be moved in at the standard cost that we have allocated for the project. So here they're going to come out of our materials purchase control account for the actual quantity that we're using, but it's going to be compared to the standard quantity that were allocated here or allowed for the specific project here based on standard costing. So the difference between our actual quantity used and their standard quantity allocated here is going to be our direct materials quantity variance here. All right, so that's how we work with this here. But before we get into those accounts here, let's just go down and let's look at just our key here. So for what I'm showing here in AP, that's our actual price. SP stands for the standard price. AQP stands for the actual quantity purchased. AQU here stands for the actual quantity that we used. And SQA here stands for the standard quantity allowed here. So that's what I'm showing here in our T accounts. Okay, so starting out with our accounts payable here for our actual purchase here of those direct materials. So let's look at that here. So we're going to record it at their actual cost. In this case, the actual price here that's paid per unit here is $10.20, and we're going to purchase a quantity of 22,000 of this particular material here. So that $10.20 times 22,000 is going to give us, in our accounts payable for our actual cost here, $224,400. Now they're going to be inventoried in our materials purchase control account here at their budgeted standard price here, standard cost. So this is the case here where we're going to take, in this case, our standard price, or what we have for our standard costing system here, what we budgeted for each of these, for this particular material that we're buying here, we budgeted at $10 a piece here, but we've actually are going to paid here $10.20. So you can see there's a difference here. So first off, looking at our what we record here as a debited in our materials purchased account here, take the $10 here times, in this case, the actual quantity we purchased, the 22,000 here. That's going to give us 220,000 here that we would increase our materials purchased account by. So you can see here we have a difference between what we actually paid here, 224,400, versus our budgeted, or based on our standard pricing here, 220,000. So the difference goes into our direct materials pricing variance account. And what would the difference here be? The difference is $4,400. 224,400 comparing it here to $220,000. So it's going to go in as a debit amount here because you've had a credit here in your accounts payable at $224,400, debit here $220,000. So the difference is a debit here in your direct materials pricing variance account of $4,400. In that, you can look at it in terms of you take your actual price here versus your standard price here on a per unit basis. So the difference here, $10.20 for the actual price, standard price here $10, times the actual quantity that we purchased here, 22,000, quantity of 22,000. That is going to give us what? 20 cents. The difference here is 20 cents times 22,000, quantity of 22,000. So our direct materials pricing variance would be $4,400. And I've got a mark here, either U for unfavorable debit. Increase here in your direct materials pricing variance accounts means it's unfavorable. That means you have paid more here than the budget. Your actual price here is greater than the standard cost that you established on this particular item here, times, again, your actual quantity purchased here. And this, again, based on our quantity purchased here for this direct materials pricing variance. You can also look at it in terms of quantity used here. It's less seldom used here, and we'll look at that case as well here. But the key is here, it's unfavorable, again, because we paid more than we had our standard price, established standard price on this product. Had the reverse been true here, had we paid less here than our standard price here, then we would have had a favorable direct materials pricing variance. It would have been credited here or reduced by whatever the difference was between our actual price that would have been less than our standard price. Now, if you didn't even know any of these quantities here, you didn't have any quantities, all you were given is the numbers that we had here, $224,400 in your payable account here versus what you record here at what you had recorded here at your standard costing here at $220,000. You can see just the difference here. You'd have to come up with the balance would have to been a debit here to direct materials here, $4,400. You wouldn't even have to know these quantities. We go through we do this here because we have to know our quantities and our prices and what's going on here. But I'm just saying how that would work. Okay, so now we've figured out our direct materials pricing variance here, and that was based on our actual quantity that we purchased. Now let's go and determine our quantity variance here. Now this is the case here where in our materials purchase control account, we're going to take it out at the budgeted standard price per unit, but we're going to take it out here at the actual quantity that we used here. So materials purchased for the actual quantity we used for this specific job here. Let's look at it. We're going to have used 20,050 units here of that product. We purchased 22,000 here, but we're only going to use 20,050 of the units here. We take it times the standard established price here for our standard costing here at $10 a piece. So our materials that our control account here, it's going to be reduced here by $10 times 20,050 units here. Reduced, that equals $200,500 here. Okay, so that's based on our actual quantity we used here and our standard price. But now when it flows into the work in process account here, it's going to come in at its standard cost. And what we mean by standard cost is this is where we're going to have to take it based on the standard quantity allowed for this specific project here. We're going to have used a certain quantity of this material here, but based on our standard costing, we only have a certain we have a standard quantity that we allowed here for the job. Yeah, okay, so our work in process is coming in at that amount here. So let's say our standard price was, again, the $10 here per unit, a standard price on a material here, times the standard quantity allowed for this job here is 20,000. We purchased $22,000, a quantity of 22,000 of this particular material, but for our work in process based on that project here, we only allocate or allow 20,000 of those quantity here that we can use. And again, we're going to have actually 20,000 here for the work in process. We can only understand that the standard quantity allowed here for the specific project here is quantity of 20,000. But we actually used here a quantity of 20,050 here. So this is where our direct material quantity variance comes in. Standard quantity allocated at 20,000, standard quantity, actual quantity we actually used here, 20,050. So the difference here, actual quantity used here, 20,050, less our standard quantity allocated here, 20,000, times our standard price here at $10 here per unit, is going to give us our direct materials quantity variance here of 500. Again, just a balancing entry here between our budget, what's coming out here at the actual quantity we used here, 200,500, versus what our standard quantity allowed here at 200,000. Difference goes to the direct materials quantity variance here for debited here for $500. Just balancing our credits here with our debits. And again, looking at it in terms of the actual quantities here, because we actually, the quantity that we actually use here is 20,050, or a quantity of 50 more than what our standard cost or standard quantity we allocated here at 20,000. So that's how we get our direct materials quantity variance, again based on quantities. Again, in times the difference in our quantities here times the standard price per unit. Again, you can see this was unfavorable here because we had to debit our direct materials here for $500. Just a balancing amount here. 200,000 here plus our 500 here in our quantity variance account equals our credit here of the materials that we actually used here, 200,500. Just a debiting amount. Again, if you didn't know any of these quantities, just knew your amounts here, you could see where you'd have to come up with in direct materials quantity variance here of $500. Now, if the opposite was true here, had we used less here, say it would have been 19,000 some units here versus the 20,000 that was actually allowed here, then we'd have had a direct materials quantity variance that would have been favorable here. Credit would have been favorable amount here. So just understand how you get these, understand your debits and credits here based on your balances here in your materials purchased accounts here and your work in process account. So that's how it works here. Any debits here in your direct materials quantity variances is unfavorable. Any credits is favorable. Same as we had in our direct materials pricing variance account. Okay. So we've gone through that here just to understand, again, just to go over direct materials pricing variance here, that was simply based on our actual price versus our standard price that was allocated here times the actual quantity purchased, and that in this case gave us a unfavorable pricing variance here based on prices here times the actual quantities that we purchased. And then for our direct materials quantity variance, that was based on quantities here. Actual quantity used versus the standard quantity that was allocated times your standard price here per unit. That's where you get your quantity variances here. So that's how it works. And this was based on our quantity purchased here. Now let's just go over these T accounts here one more time just so you can jot these down here if you don't quite understand all these letters here. So for our direct materials here, that it was our actual price minus our standard price here, actual price minus our standard price times the actual quantity purchased. That's for direct materials pricing variances. And then for direct materials quantity variances, it's the actual quantity used minus your standard quantity allowed here times the standard price again. Okay, so that's for our price and quantity variances. Now let's move up to our accounts payable here for our actual cost. So this is where you take your actual price times the actual quantity purchased up here. And then for our materials purchase control, the budgeted numbers here. First for our inventoried amount here, I've got that shown here. That's the standard price times your actual quantity purchased. Okay, so that's how we brought the inventory in here. So now when we used up the inventory here, this is the case here where you take your standard price times your actual quantity used. Standard price times the actual quantity used. Okay, now one last thing here for our work in process at our standard cost here. This is where you take your standard price times your standard quantity allowed here. Standard price times your standard quantity allowed. Okay, so that's using our standard costing system here to determine our direct materials pricing variances here and quantity variances. One's based on difference in price for your price variance, obviously, for the direct materials in this case. The other was based on your difference or your quantity variances here. All right. So one last thing that we want to look at here. Okay, now let's just move over here just to make a point of this here. So all the numbers, same as what we went through and over there for our variances here, for our pricing variances and our quantity variances. Everything being the same. The only thing is sometimes This direct materials pricing variances here is based on the quantity used rather than the quantity purchased. So if we look at it in these terms here, just take we'll take it a direct materials pricing variance. Let's say actual price here was $10.20 times our standard price here of what? $10 here. So the difference is 20 cents again here, times not the actual quantity purchased here, 22,000. If we're basing on the quantity used, that is 22,050 units here. That's the actual quantity that we used here. So this is direct pricing variance is based on the actual quantity used versus what we looked at before was the actual quantity purchased. Only to make that difference. And if you do your arithmetic here, your direct materials variance is going to be $4,010. It was $4,400 here based on the actual quantity purchased, but the actual quantity used, it's less here. Okay, do you only make that point here? All right, and then one other thing, just to go through the definition here one more time. If you just want to look at the pure definition here, you take your direct materials pricing variance, and it's usually based on the actual quantity purchased here. So if you had the actual quantity used, then you'd have to plug that in here. But the direct materials pricing variance, by definition, it's the actual quantity purchased times the actual price, and then you subtract from that the actual quantity purchased again here times the standard price. So again, we're just for a direct materials pricing variance, we're just comparing our actual difference between our actual price here and our standard price times the actual quantity purchased here. And then for our direct materials quantity variance here, by definition, what you're going to do is you're going to take your actual quantity used times your standard price here, and you subtract that here from the standard quantity allowed here, again, from the standard price. So you're taking your differences, your actual quantity used, less your standard quantity allowed here, times your standard price. Okay, so by definition, that's what we're looking at here, just going out for direct materials pricing variance. That's between your, in this case, if you look at it, quantity used here or quantity purchased here, really looking at the difference between your actual price here that you paid minus your, comparing your actual price you paid here to your standard price allocated for the particular project times whatever quantity you're going to be using here based on the purchase quantities here or quantities they actually used. And then direct materials quantity variance, just say again, it's based on your difference between your actual quantity used here and your standard quantity allowed or allocated for the particular project here. You just have to understand that times some standard price, that is going to give your direct materials quantity variances here. All right, so that'll pretty much summarize our subject.